A CLO is a collateralized loan obligation, and it's a special form of structured finance product that's created when you pull together a diversified portfolio of senior secured loans. Now, these loans are usually made to be low investment grade companies, basically high yield junk bonds. Now, CLOs are structured into different tranches based on the risk and reward. The most senior tranche has the lowest risk and the lowest return. The most junior tranche, or the equity tranche, has the highest risk and the highest returns. Now, closed-end funds, on the other hand, well, they're a special type of investment company that raises a fixed amount of capital through an IPO. It then invests that capital into a pool of securities. Now, unlike open-ended companies, which can issue and redeem shares on a continuous basis, the closed-end fund issues a fixed number of shares that will trade on the stock exchange. Now, CLO, then, in a closed-end fund format, is a special form of investment company that invests in a portfolio of CLOs. The fund has raised capital with the IPO. It invests that capital into a diversified portfolio of CLOs. It's then listed on the stock exchange. We, as investors, we can buy and sell this throughout the day. Now, the CLO closed-end fund has several big advantages for investors. Number one, it gives us access to a diversified exposure over high-yield loans, which can offer some very attractive risk-adjusted returns. Now, number two, it can also offer a very predictable and valuable stream of income in the form of dividends. Now, this is also a very nice way of diversifying over different asset classes. But, of course, there are some risks. Number one, the value of the underlying CLOs can be affected by changes in interest rates, credit spreads, and other market conditions. Companies can go bankrupt, and so the company here will not always collect all of the money that has been loaned out. And another risk here is that the actual shares for the fund can trade at a discount or a premium to the net asset value, and this can also have an impact on your total returns. So as always, you need to think about the risks as well as the rewards, but CLOs can be a very nice way of diversifying your portfolio, giving you access to credit markets in a way that we haven't had before. What do you think? Is this going to be something that you will look at in your portfolio?